China conducted a 1 trillion yuan stimulus overnight. We're going to take a look at what that entailed. And the Aussie economy is running a little bit hotter than expected. CPI came up a little bit higher than the expected number at 5.2%. We're going to take a look at that as well and how it relates to the Aussie dollar. And the Trading Takeout today is going to be why you need to focus on doing things other people don't want to do in markets, with a fantastic Twitter thread by someone that I recommend everybody should follow if you are on Twitter. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So yeah, you heard that right. China has kicked their fiscal stimulus into overdrive with deficit busting 1 trillion yuan in new debt. So they've issued 1 trillion yuan in bonds to try and stimulate the economy. Now, I do apologize for the zero hedge link. I don't normally go on zero hedge, but they've actually curated this quite well with some decent charts. So this pushes their total debt to over 300% of GDP. Now, everyone talks about the US being, highly indebted, all the printing that's gone on in the US, but rarely do they actually speak about China. China is the most heavily indebted country in the world, or large country. And the big problem with this as well is that there's still a relatively closed economy in terms of how capital can flow in and out, while also being stuck in the conundrum of relying on other countries for their exports. They're not a consumer or domestic consumer demand-led economy. They are heavily reliant on the US, for example, as their largest trading partner, Japan, UK, loads of other countries. And so they're in a really, really tricky spot now. And I wrote an article a couple of years ago before the Evergrande stuff came out. And I had mentioned that Evergrande was going to, blow up, basically. And when you look at their demographics, they really, really look like Japan before the lost decades. They look like Japan in 1989. In 1989, and this is something to note more recently as well with how the Nikkei has performed, the Nikkei peaked. And the Nikkei has never actually regained that 1989 level. Never. It's only about halfway there now. And I think this is very, very reminiscent of how the Chinese stock indices have been behaving as well. I think the Chinese stock indices, for all the power and might that China has, this Chinese stock indices are really, really poor. And even if you look at the Hang Seng is not great either. I'll just put it up quickly here. Let's look at this one, share this tab. Like, if we zoom out to, say, a monthly chart, the Hang Seng only peaked in 2018. And it's never regained, even though, during COVID, there was massive fiscal stimulus and monetary stimulus, which lowered bond yields, lowered the risk-free rate. And really, you'd have expected it to have gone higher. But no, it's just been flat. Obviously, that's not with dividends being reinvested, but it's not the point. It's just been turgid for the world's largest economy to have their, I don't necessarily want to get into the politics of Hong Kong and China, but to have one of their largest stock exchanges do really, really poorly is not great. It's kind of akin to the UK, to be honest. And so I think, it doesn't look pretty for China. And if we go back to this piece, we can see here that their budget deficit is absolutely huge as well. If this were to be in any other nation, in Europe, for example, the European leaders would be, or the EU or ECB, they'd be saying you have to go into austerity right now because that's just not sustainable. It's a really, really mind-boggling situation, and it's compounded by the fact that 72% of household wealth is in property in China. And we know what's happening to Chinese property prices. They're being absolutely decimated. Country Garden, which is the largest and always has been the largest, I don't know why Evergrande has always been mentioned as the largest, but Country Garden just defaulted on their dollar bonds today. They're bankrupt. They're going to go under. And, the fact that property and household wealth is so connected, is truly astounding. For context, in the UK, which naturally we have a massive, massive love for property investing, it's only 52% of household wealth. So you've got China at 72% and the UK at 52%. That's a massive difference. And we know how sensitive our government and our, I guess, population is to the change in property prices. If property prices come down a bit, everyone's going mental. They're like, oh my God, my wealth's going, everything's wrong, get them back up, even if it makes everything unaffordable again. So China's in a real sticky situation. And I don't see how the current stimulus that they've just enacted is going to change anything, because with stimulus, you need demand. You can't just stimulate and then, expect that it brings demand. With stimulus, you need there to be loan and credit demand, and it just isn't filtering through. And I think the best example of how the market's taken this is just looking at the Hang Seng. It jumped up on the stimulus news, and then it's just trading back down. It doesn't care. It just sees it as totally ineffective. So this is the situation that we're dealing with China. I think that any form of stimulus now is one to be faded if you do indeed trade Hang Seng futures. Aussie dollar could be a play on this, but I think there's better reasons to be trading the Aussie than looking purely at China right now. But yeah, we're going to move on to the Aussie now anyway. So the verdict on China is that it's in a really, really sticky spot. They can try and pump stimulus into the economy as much as they want, but I don't think it's going to do much. We're just focusing down here at the Australian CPI, and it came out hotter than expected. So 5.4% year on year versus expected 5.3%, previous 6%. So there is disinflation coming into play. But as traders, all we care about is whether it beats or misses the expected number. Over the long term, if you're a position trader, then of course you're going to be focused on this bit as well. But shorter term, intraday, intra-week, it is just the expected. Now, how did the market react off of this? Well, let's have a look at the Aussie dollar very, very quickly. And what we can see is that we had a little boost up here, but then it's faded it. Personally, I see the China issues as actually weighing a little bit heavily here, but in reverse. So I wouldn't use the Aussie dollar as a proxy for China. I would use Aussie issues first and then see what's happening in China. But you can see here that I think that what's happened straight from this is that because Chinese demand is likely to wane further alongside Australian interest rates perhaps requiring to go up, the differential here, the yield differential, isn't actually widening as much as you'd probably expect. And what we're probably seeing is that the RBA are between a rock and a hard place. Australia also has a massive problem with housing market. And they're probably not going to want to increase rates too much to upset that either. They're probably already there. It does take some time lags for it to work through to the real economy. But the way that I see the Aussie right now, especially in conjunction with the dollar, is the dollar's doing its wrecking ball thing. It had a bit of a softer day yesterday, but it's doing the wrecking ball. And I think in a month's time, we're going to see the kind of damage of this. I think we're going to be at peak rates in a month's time. Absolutely. I think everything's going to start getting priced out in terms of higher interest rates. And that's really when the dollar is going to accelerate a little bit further to the upside. I think we start to see the euro come down quite heavily. And I think in terms of the Aussie, I wouldn't be surprised if we were to see, let me just take this moving average off, if we were to start to see prices looking, down at 0.615 or something like that. I really, really do think that we should get down there. And I mentioned that a couple of weeks ago as well. It did look to me like we were ticking down to this low and then even potentially down to 0.55. Reasoning, I just see the Aussie-China relationship as being quite strong. There's a really strong dynamic there. And if China's not buying from Australia, then it just shows where demand is globally, really. China is the warehouse and factory of the world. And it gets a lot of its commodities actually from Australia. They're a massive trading partner of Australia. And it tends to be that if Australian exports to China are declining, that's not great for the Aussie either. So we're playing this in terms of, looking at the risk sentiment generally, which is slightly poorer. It's not awful, but it's got poorer for sure. Aussie demand waning from China, that is. And then the wrecking ball of the dollar. So that is pretty much where I see things in terms of the Aussie. I do see it pointing lower. So this tweet thread is absolutely fantastic, and it's a perspective on markets that most probably don't think about. And when we get down to it, the crux of trading and what the process should be is doing things when most other people don't want to do them. So, for example, this thread basically goes through. I'm not going to go through it all. But there's a reason why good trades work out, and it tends to be because you are providing a price. You're providing a price to the market at places where others potentially deem it to be disadvantageous. That's called your edge, basically. But at the end of the day, what you're doing, if you're using things like technical analysis, macro, all of this kind of stuff predominantly without thinking about who your counterparty is and what they're probably doing at the time, is you're just going to be joining a crowd of people who are all getting shafted. If you think of the amount of people who lose in retail trading, it's about 80%, 75, 80%, right? So you're joining a crowd there most likely. Now, the people that aren't doing this are probably thinking about, okay, well, what is the positioning now? Who is in the market at a disadvantageous position, and how can I exploit that? Where will be the points where they become unstuck, and how do I retrade back to get to those points from a decent entry? And I can put this link in the YouTube description so you can have a read of it. But it's fantastic. It's very comprehensive. And it's well worth your time, because it really starts to get you thinking about what you should and shouldn't be doing outside of your everyday analysis.